You are listening to the REI Mastermind Podcast. Join JD as he chats with industry-leading real estate experts and professionals. We learn from their experience and uncover the strategies to their success that we can implement into our own businesses, and we can drive immediate results today. They share their experience and wisdom as we build a foundation to our own success. This is the REI Mastermind Network.
We have Joseph Viery on the call. Joseph, I really appreciate your time. And we're going to tackle something that's near and dear to everybody's heart and is usually very riveting, is how we can save some money on taxes.
Thanks, JD, for having me. And yes, we are going to show your listeners how they can do that exactly. Yes.
So with that, I wanted to make sure that we point everybody to your website right off the bat. So head over to USTAGinc.com. I'll make sure to include that link in the show notes, but is there any other place that you prefer to have people contact you?
That's the best place. Yes. Go right to the website.
So we're going to tackle something that can get pretty deep in the woods. So we might slow down on a couple things just to define a couple terms and so we understand how this works. But in a nutshell, we're going to be talking about accelerating depreciation and through cost segregation. So before we start with anything, we better define what cost segregation actually is.
Okay, fair enough. It's a unusual topic in that, yes, I have my feet in a couple different worlds. One is engineering, one is accounting and IRS regulations. And what we do is an engineer-based study. And what cost segregation, to make it a very high level, is you hit the nail on the head, is we accelerate the depreciation. Depreciation using straight line, which most accountants will do, is simply for residential properties, is simply dividing by 27 and a half years. So you whatever you paid for the property, we don't care what the fair market value is. It's what you pay for it, less the land. Land is not a depreciable asset. Divide that by, get a calculator, and you're a young person can do this, divide by 27 and a half years. And that's the expense that the IRS allows each property owner to take every year. And when I say expense, the concept is the IRS recognizes that you're using up your building as you own it. Mm-hmm. Now, that's easy for an investor to figure out because they're going to need carpet every 3, 4, 5 years. So you know you're using up your building. But the IRS takes this to more of an extreme, meaning that they're going to give you the ability to use up or expense your building through time for residential. And the answer to the question of why 27 and a half years, I have no idea. For commercial buildings, meaning everything but residential, it's 39 years. So you can just do the math and figure out you're getting a very small expense every year by using straight line. However, the correct way is to break out the personal property and the land improvements, and that accelerates this process. And the land improvements are 15-year items. The interior of the building is 5 years, and the interior of the building, which is personal property, are items like countertops, cabinets, flooring, window coverings, accent lighting. And there's hundreds and hundreds of components of the building that fall into personal property. And there are hundreds of components outside, like sidewalks, landscaping, irrigation, fencing, improvements like swimming pools, jacuzzis that are built in the ground, those kind of jacuzzis that are land improvements. And so if you put the land improvements of 15-year, the interior 5-year, and you're going to have your core building of 27 and a half year, which is the foundation, the walls, the windows, the doors. That'll still be there. But if you can combine the personal property with the real property, you get the effect of accelerating your depreciation expense.
So, I see how this could really benefit, especially somebody with a multifamily property. Would this also work for somebody who's buying single family homes?
Yes. We do both $500 million buildings to your single family home. And starting back when I first started in 2008, we all conformed, well, any reputable engineering company conformed to the audit technique guidelines by the IRS that were published in 2004. And basically, if you go and you look at the different, methodologies that they recognize, the number one methodology is the detailed engineering approach. That means that the engineer or one of our staff would have to go to the building. So I would have to fly to Washington or Florida or Maine, and I have to measure all of the property, and I have to photograph the property, and then the engineer has to take the plans and all the information we gather, and they do the report. Well, as you can imagine, that's expensive.
Mm-hmm.
So we've also developed about 5 years ago a statistical analysis that the engineer can do using pictometry software, meaning satellite software, and we can look at the building, get the information we need to accelerate the depreciation without having to go to Kansas and look at the building. And because of this, we can do these studies for hundreds of dollars, not thousands of dollars. So if the building has a basis of $500,000 or less, we can model that building. If it's over, we have to do the detailed engineering approach.
Sure. No, and that was going to lead me to my next question is like, at what point do you decide whether the return on investment is there to do this type of acceleration? But you pretty much answered that. If you manage to pull this off.
What we do is we provide a no-cost estimate. So here's
Sure.
the analysis. It's very simple, but here's Joe's analysis. We look at how much I'm going to give you in accelerated depreciation and how much you're going to save in income taxes. We quote you the fee. And then basically what I like to present is a minimum of 10 times the fee. So if I charge you, I'm going to make this up, $500, I want you to save at least $5,000. If you save under $5,000, Joe will tell you, don't do it. Now, some clients, they say, if I pay $500 and I save $4,000, it's good enough for me. Well, that's your decision. I think 10 times whatever I charge you. So if I charge you for a full detailed study, $3,000, I would want you to save in your pocket $30,000.
Mm-hmm.
And I don't charge for the first round. I do the estimate at no cost.
Sure. Can you give us a real world example of how this worked for one of your customers? And what kind of, if we could focus on maybe a single family home, because a lot of people, that's kind of where they start when they get into real estate investing.
And we will do just one home or we'll do a portfolio. So if you have one home, let's say that you purchased it for $120,000 and you allocate. Now, we're not land appraisers, so we don't know what the land is. I can give you my opinion on what you should allocate to land. One of the best is by using the tax assessor's allocation, but sometimes they're really wrong. So, you got to look at it. So basically, if we look at the tax assessor and he says, oh, the land should be $20,000. So now I have $100,000 to work with. 120 minus 20 is $100,000 for the building. And basically, if you divide by 27 and a half years, that's like $3,300 expense. I will tell the client, or not I will tell, but in a real study, I will probably carve out about $33,000 for accelerated depreciation. So that means you're going to get a $33,000 expense or write-off against your income taxes if you accelerate the depreciation for that tax year, which is tax year like if you bought it in 2020 and you're on extension, that would be tax year 2020 income taxes. I would give the owner $33,000 accelerated depreciation expense. That's how it works. And it just depends on the building. So when I say we have to estimate, we have to look at each building separately. And so we go online, we look at the building from satellite, and we determine how much we think we can estimate on what we'll find. Now, granted, our estimates are lower than the $33,000. I would probably estimate closer to $25,000, just in case there's some wrinkle, something out there that doesn't conform. So I'll tell the owner, okay, I'm going to save you $25,000. Is it worth spending $500 to get a $25,000 depreciation expense? If you're savvy and you understand the time value of money, the answer is always yes.
Mm-hmm. So what's the process there? You say you can do this now with satellite imaging and all of that. Do you still need to have some eyes inside the building? Like,
No.
No?
Because basically what we're doing is we're using our database of tens of thousands of buildings we've looked at. And, our statistical database then takes and it says, okay, here's a 3-bedroom, 2-bath home, 1-story in St. Louis. And so then we will take 1,500 square feet and we will take our statistical analysis and we'll tell the IRS, okay, this type of building located in this area is going to, our statistics say this is how much personal property inside, how much land improvements outside. And we also look at the land improvements and we say, okay, there's fencing, there's grading, there's a swimming pool. So that's incorporated in that. And then our statistical analysis will perform the study. So we don't have to go out there. And again, I can't quote you the fee because we look at each building separately.
Sure.
But I would say hundreds of dollars so people know that this is not this is an affordable process.
Right. And how quickly does something like this get turned around? Like when somebody is interested in this type of breakdown?
30 days from when we get all the information in. So by information is I'm going to ask, okay, do you have an appraisal? Do you have any plans for the building? Now, most of the time for single family homes, the answer is no, 95% of the time. So no. So basically, what we need to do is we need to get whatever documentation is out there. As soon as I have all that documentation, which doesn't take the owner of the building long to produce, then 30 days from that, we will deliver the final study. The advantage of using my firm is that we defend our work. Mm-hmm. Now, I know where we're going to go down this road, so I'll just head everybody off right now. I've been doing this a long time. We comply with the ATG, the Audit Technique Guidelines. We have never had any of our work called into audit. Now, we've had the client called into audits for other reasons, and then the IRS agent will go, oh, you did a cost segregation. Oh, let's look into that. And they'll look into it and they may have a question. They'll go, oh, how did you get so much flooring, vinyl flooring? How did you calculate that? And how did you come up with this pricing for that? And so bottom line, we'll get on the phone with the IRS agent and we'll tell them this is how he did it. And then not usually, every time the answer is, okay, great, thank you. Hang up the phone. They're done with our study. Mm-hmm. That's the extent of the questioning we get. They just will not question our work because we have the credentials.
Sure. So you mentioned if you were planning on doing things with the property, like what are you talking about there when it comes to if you plan on doing some additional updates? Is that what you were saying?
Yes, doing some improvements. So on the full detailed study, engineering-based study, it's a minor point. That's not to be. It makes no difference how and when you did the improvements. But for modeling, we can only model improvements if they are done when the building was acquired, before it was placed in service. So let's say somebody bought the building January 1st, and then September 1st they did improvements. I can't look at those improvements. I can't look at that $20,000. But let's say somebody bought the building January 1st. It was vacant, or the tenants, were moved out, and then they spent the $20,000. And then March 1st, they put the building in service. I can look at the $20,000 and add it to the basis of the building. So the example I gave you for the $100,000 building basis, I can then look at $120,000 and include the two. But if you do them in separate stages, I can't look at the improvements. Is it the end of the world? No. It just means I can't accelerate the 20,000, and the 20,000 acceleration is not the main nugget. The main nugget is the building core. The one thing I do have to point out and let everybody, they do have to realize this, is that the modeling study is only to get to point B. It is not meant to replace the full engineering study. So what does that mean? It means we are doing only one thing only, and that is accelerating the depreciation of the building. So if anybody wants to get into the nuances of this, you can, when you do improvements, you can, if you throw something out like the countertop, which most people do in value add, the modeling study is not going to give you the amount that you threw in the trash of the countertops. The full engineered study will, but not modeling. Because all we're doing when we model is we're saying, this is how much 5-year, this is how much 7-year, this is how much 15-year, and this is how much 27.5-year go into the building. But we're not breaking out all the components. Because obviously time is money, and we're not putting that kind of time into it. So that's all it gets, is just accelerated depreciation only.
So, another big change that typically happens is when the property changes hands. Like, does this impact, or when can you still take advantage of this if you're going to sell the property?
Okay, here's the rule of thumb. It's a good question, JD. So there is a component called depreciation recapture. That means the depreciation you've taken through the ownership of the building has to be paid back when you sell the building. So if somebody is not going to plan on holding the building at least 1.5 to 2 years, we would tell them, don't do it. Because by the time you pay me, by the time you put time to get the study done, and then you're going to have to pay some of the depreciation we're accelerating back to the government, forget IRS, it's not worth it. So basically the 1.5 years, and what are we looking at? We're looking at the time value of money. If I save you $10, and let's say your internal rate of return, meaning you can take that $10 and you have a 60% internal rate of return, you still might want to do it, because if I give you $1 today and you can double it in those 2 years, you may say, forget it. I'm going to still do cost segregation because Joe's giving me X amount of money, and I'm going to take and buy more property or whatever you want to do with the money. So that's what we look at. We look at what you can do, what the investor can do with the $1 if I save him $1. But overall, we just feel 1.5 years is probably the minimum time for the hold. And if you're going to sell it within, you're a flipper and you're going to sell it in 1.5 years, the answer I'd give them is don't do it.
Sure. Well, on the flip side then, how about acquisition? Like, you haven't been doing this acceleration up until now, and you've held the property for a couple of years. Are you still able to take advantage?
Yes. So we have 2 types of studies we do. We have look-back studies, which is everything purchased prior to the current tax year. So right now we're in tax year 2020, people on extension. People who filed May 17th, their tax year's over. They're done. And so bottom line is this year, 2021 is going to be, that's what this property would be for if they bought a property in 2021. But let's say you bought a property in 2020, you're still in your current tax year. So let's say you bought a property previous to 2020, 2019, that's a look back study. And again, there's no definitive answer, but my feeling is that we can go back and still give a quality study for about 15 years prior to acquisition. So we're looking at 15 years prior to 2021. We're looking at about 2006. So if you bought the property around 2006, call me up. Let me run the numbers and see if it's worthwhile to go back and do a look back study. Okay.
So, this is actually something, a fairly newer concept to a lot of my listeners, the cost segregation. Is this a pretty common thing that the IRS is used to, or is this going to throw a flag and somebody's going to be?
That's a great question. Great question. So here's the deal. When I first started, the number one comment I got is, this has got to be a scam. Now, keep in mind that when we do the full detailed studies, I'm saving a lot of my clients millions of dollars. I save some of my big clients $20 million in income taxes. So obviously, when you go to a corporate entity and you say, I'm going to save you $20 million, they go, no way, that's impossible. And then you go through the education process and explain, yes, it's real. That's what exactly that's how the IRS wants you to depreciate a building. So now, fast forward to 2021, we should be completely over that. This is a scam. Right now, we're into more or less that an accountant can't do what we do. So people just don't know about us. They don't know that they can accelerate their depreciation unless their accountant is savvy enough to tell us about that. But as far as the IRS goes, the IRS knows that it's the proper way to depreciate a building. So there's absolutely no pushback, no red flag. It's business as usual for anybody who owns real estate. I would think the IRS would probably wonder why the property owner isn't doing cost segregation. And that may be the red flag for them to look in and see, why is this guy not doing cost segregation when his accountant should know that there's cost segregation? But they don't know that companies like mine exist.
Well, I would guess that a lot of tax preparers, especially when it comes to real estate investing, they may just not be fully versed on this either.
True. Yeah.
So.
I mean, I work with accountants. Part of my job is education, because there's so many misconceptions like, oh, you can't go back to prior to 2020. Yes, we can. The thing is too, this is really important. What you do when we do a look back study is we're not redoing the tax return. Okay. The IRS, because of that court case, they grandfathered in cost segregation as the only reason to do the change of accounting that's guaranteed approval by the IRS. You don't have to wait for approval. If you do cost segregation and you look back, it's a guaranteed approval, and you do not have to amend the tax return.
Sure.
That's big, because amendments are the kiss of death.
Mm-hmm. So, one of the things that I like to do in every episode is give people some actionable items. So if they were looking into doing this type of thing, and, you are the low-hanging fruit. I mean, why not just contact you directly? And I'm going to plug your website again at ustaginc.com. And like I said, I'll make sure to include that link in the show notes. But if they were looking at other companies like this, what kind of questions do you have? Like the top 3 questions they should be asking?
Number one, the experience of the partners. And here's the problem I see out there doing it as long as I've been doing it, is that just by human nature, what sort of happens is that you get an accounting firm, and a lot of accounting firms, the light bulb goes on and they go, oh man, we should be doing this. Okay, but you're accountants, you're not engineers. So how could you be doing this? And so they get the very ill-equipped, ill-prepared people. They'll get a construction guy to do heavy lifting, and that won't withstand audit. Mm-hmm. So look at the experience. You want PEs, you want professional engineers behind the scenes who either wrote the programs or they basically do the work. So that's number one. Then you want the experience of the people. You want to know how many different buildings they've done. We haven't counted, but we've done over 10,000 different studies throughout our lifetime. Mm-hmm. And so that's what you want to look for. You want to look for people who are experienced engineers. The one thing the IRS does not want is to an accountant or the property owner to say, I did it. I did all the work. Tell you right now, you're going to get roasted and you're going to get spit out, because the IRS will not accept that kind of work.
Yeah.
So here's one thing that's important. So when we do our work, this is the behind the scenes, but I think everybody can understand this. You have to understand that when I have that $100,000 building, all of the building components and their values, which we break out as engineers, are not what you buy a 2x4 at Home Depot. Mm-hmm. Everything, that 2x4 is all tied into how much you paid for the building. And that's a complicated process that most people just don't know how to put the pieces together. Because how would a client know? Sure, they can tell you what a 2x4 costs at Home Depot. They can't tell you what that 2x4 cost when it's tied into the building basis.
Yeah, and while we're recording this, lumber and some of this stuff is fluctuating pretty crazy right now. Does your calculations take into account that, or is it just kind of a flat?
Here's what we use. We use an IRS-approved resource called RS Means. Do you know them?
No.
Okay, well, some of your clients would know who RS Means is. And RS Means and Marshall and Swift, I believe, are the two. We use RS Means, and all of our pricing indexes are into RS Means. And we have up-to-the-date pricing based upon all the factors, where the building was located, when it was built, how much was paid, and all of that is all tied into the RS Means model. So we don't have to worry about what the pricing for a 2x4 has nothing to do with our work.
Sure. Okay. Well, this has been very educational. And before I let you go, I want to make sure that we direct everybody to your website again, ustaginc.com. Make sure you check out the show notes. We'll put that detail there, including, I know you're pretty active on LinkedIn too, so we'll probably sneak that link there for people as well. Okay. But I'll usually end with my final question. Is there a question you wished I would have asked you here today?
JD, you were good. I say, I think for the first time around, I think we did a pretty good job. I think there is one small question, but it's kind of a segue. But I think it's valuable to think about. Is that we're also involved in energy studies. So if there is somebody out there who's doing value add, meaning they're improving a property, I will tell you, because of all of the laws on the books, you cannot do that without buying energy approved lighting, HVAC, and windows and doors, because Home Depot won't sell them anymore. They only sell what's compliant. And if they're compliant, there is an energy savings, another different study, which has to do with energy savings. If you save energy on your building, you can get a tax credit, and tax credits are powerful.
Sure.
So, yeah, there you go.
Yeah, we probably could do another episode just on that. I can imagine. Would you find that energy savings, does that vary by state?
No, it's a study that has to be done by an engineer, and it's different matrix than cost segregation. So it's an energy savings, and we have to test the building. So therein lies the problem, because the equipment that we use to test the building has to pretty much be driven to the building. Now, we don't necessarily have to do all the buildings, but we at least have to go to Ohio and do one building. So therefore, it's just a cost function is like, okay, we're going to give you tax credits. But by the time the engineer gets in his truck and drives over to Ohio, what's the fee going to be? The fee itself is not expensive. It's getting the engineer to that place. So obviously, if somebody has 20 buildings, okay, that's a slam dunk. It's going to be worth it. But if you have one or two, then there's a problem. So like maybe you might need to get other in your state who own buildings so we can combine the overhead.
Sure. Yeah, like I said, we probably could spend a whole episode on that. I really appreciate your time. This has been a great education around cost segregation, and hope you can join me again sometime.
I sure can. Thank you, JD. Appreciate it.
This has been the REI Mastermind Network. You can already tell that we've made some changes, and a few more are on the way. If you are interested in what we have planned, head over to patreon.com/REI Mastermind and support the show today. Financial contributions are always appreciated, along with a like, share, and review. It really helps us grow and reach more people with this valuable information. See you next time, and tell a friend.